My thoughts on the Maryland real estate market in 2026 just shifted. Many people are looking for the perfect time to buy, but what's hidden behind crazy headlines like seller beware, home buyers are canceling more real estate deals than ever. If you believe the headlines, you might just miss out.
Goodbye, Benny.
After working in the real estate industry for over 21 years and helping families here in Maryland buy and sell, I wanted to share my thoughts on the real estate market because it literally just shifted today. This window isn't gonna stay open forever, so stick around so you can get ahead of the curve and know things no one else knows. So here's something most people don't get about mortgage rates. People are watching the daily ups and downs to make their decision, but it's the big picture that tells us exactly where we're going. Let me break down the numbers that matter for us. Right now, a 30-year fixed rate mortgage is sitting around 6.375%. Fannie Mae says they're going to end 2025 at around 6.1, and that drops to under 6% in 2026. I'll use that as the basis for our analysis here. So here's the math that changes everything for Maryland buyers. Take a $400,000 loan amount, or about a $500,000 home purchase, and that's right around what we see locally. When rates drop from 7% to 6%, a buyer saves $263 every month. That's $3,156 a year and over $94,000 over the life of the loan. Multiply that across thousands of buyers in the Baltimore suburbs, and you've got massive buying power coming back online. The Federal Reserve has been keeping things steady until just now. They cut the Fed fund rate by 25 basis points this month. This is their first cut in years. And they meet 2 more times in 2025 with a plan to watch unemployment and possibly cut 2 more times. This means no more crazy swings. We're looking at predictable path downward. But here's what the national news isn't telling you about Maryland. Our market has been tougher than most during these high rate times. Why? Well, basically because we've got Washington, D.C. and Baltimore job centers keeping our market strong. When rates start coming down, we might see demand go crazy because the foundation of our market is already so solid. But let's talk more about jobs in just a second. When we cross below the 6% line, that's when things get interesting. That's when all those buyers who've been waiting jump back in. And that brings us to what's happening with sellers. Before I share that, go ahead and hit that subscribe button right now. My subscribers get the inside scoop on market shifts ahead of everyone. And trust me, you don't want to be the last one to know these things. All right, we're talking about sellers getting unstuck. We might just see the biggest inventory release in years. Thousands of Maryland homeowners have been stuck and they're about to break free. Let me explain what I mean. Right now, Maryland has had crazy low inventory. We're talking 2.5 months of supply when a normal market is about 6 months of supply. And sure, we've been in this extreme seller's market for years. That is about to change in a big way. Here's what's been happening. We've got thousands of sellers with those sweet sub 3% mortgage rates from 2020 to 2022. And these folks want to move. They want to upgrade. They want to downsize. They want to relocate. But they couldn't stomach the idea of giving up a 2.8% rate to take on a 7% purchase. The math just didn't work. Now, watch what happens when that gap starts to shrink. Suddenly, it starts to make sense for people to get out of their own way and finally make that move. And we're already seeing the early signs of this. First, because Maryland's housing sales jumped 12.4% in October 2024 compared to the year before. We're also seeing new listings up 5% in Baltimore City last year alone. These aren't huge moves yet, but they're telling us what's coming. But wait, there's something else creating even more inventory pressure. Federal job cuts are happening, and that's going to push more homes onto the market. And look, When I mention federal job impacts, I'm talking about market effects of policy changes. I'm not making any political statements here. These are just the market realities that affect supply and demand. So anyway, we've got inventory coming from two different directions. Rate lock sellers getting unstuck, plus additional homes from the federal employment changes. This combo is setting us up for a shift in our current shortage that may be a more balanced market by the end of next year. And when I show you more trends later on, you'll definitely agree with me. Here's the key for sellers though. There's going to be a sweet spot where you have maximum leverage. That's right when rates drop enough to bring the buyers back, but before you're competing against a flood of other sellers. My guess, that window is between now and late 2025. Now, while sellers are getting ready to move, there's this huge group of buyers who've been waiting on the sidelines, and they are the third big shift happening right now. We are already starting to see it on our team. Sideline buyers are coming back. The buyer demand activated. So the buyer pool that's been waiting is actually way bigger than most people think. And they're getting ready to jump back in. And wouldn't you know it, Maryland is perfectly set up to benefit from these demand surges. Look at the numbers. Millennials make up 29% of home buyers nationally, and Gen X is another 24%. These are the people in their peak buying years with solid careers and growing families. And here's the kicker, around 40% of the buyers want suburban properties, which is great news for our suburbs. When I show you the examples, you'll get the full picture. Maryland's median home price is around $461,000, and here's why that's good news for us. That premium is real value. We're close to the major job centers, we've got great infrastructure, solid schools, and a good quality of life. These things drive values up. Our job market in Baltimore is also rock solid. Healthcare, education, government sectors give us a steady income stream that keeps housing demand strong. Even when the economy gets a little shaky, we've got a really diversified economy that creates consistent long-term demand. And the pent-up demand from 2022 and 2023 is huge. Market experts are already saying pent-up demand is already fueling today's market activity. As these conditions improve, so will it. These are pre-approved people looking at homes. They may even had their contracts that fell through and rates went a little crazy and they stepped back a bit, but make no mistake, they are back. Okay, but how exactly does that work out in real life? Let me show you how this is playing out in 3 areas. Each one tells a different part of the story about where we're headed. Columbia in Howard County is showing us what happens when high-income buyers meet smart development. The median home price is around $493,000, and homes are on the market for just 24 days. Buyers here are typically seeing 4 offers per property. There's a good reason for all this. Recently, Columbia was ranked as the #1 best place to live in the Southeast. That kind of recognition brings the buyers. Now, we've got Howard County's downtown makeover too, which is massive. They're planning over 6,200 new homes, plus 4.3 million square feet of office space, 125,000 square feet of retail, all around the Columbia Mall. The county put up a $90 million in bonds for the first phase to get started, all backed by property tax revenue. When you see that level of development, you know they're serious about long-term growth. The second suburb is Ellicott City. It shows us the premium end of our market. Median home prices around there is $701,000, and homes are selling in just 14 days. They're also going above asking price, about 2% on average, which tells us the demand is crushing the supply, even at those higher price points. The historic charm factor here costs a little extra, but it's backed up by solid fundamentals and access to both Baltimore and DC jobs. Now, let's look at Towson. Towson gives us steady growth with broad appeal. The median is about $498,000, up 4.7% just from last year. The university town's energy creates consistent demand, while walkability improvements are bringing in more permanent residents. It's basically in that sweet spot where families can afford to buy while still getting the amenities and convenience they want, all with great schools. All of these areas hit different price points, which means they're capturing different buyer types as they come back to the market. All three also have either developments going on or attractive prices that could bring more residents in. And I'll come back to areas like these in a second. Before I share my ideas for strategy, here are two big shifts that you need to watch. My guess is they'll determine which areas see the biggest gains over the next year and a half. These two things will separate the winners from the people who miss out, and they're both huge for Maryland's market. First up is the federal employment migration effect. As federal employment patterns change, we see changes in neighborhoods that used to be packed with federal workers. Now hold that thought, because it goes directly against a stat I'll share in just a second. Smart buyers can target these areas for value while keeping their sights on the long-term growth potential. The key is to find areas that have strong basis beyond federal employment, places with good roads, diverse job markets, solid community amenities. These areas might see temporary price dips that create buying opportunities, but they'll bounce back and grow over time because the value drivers are still there. Second is the suburban investment renaissance. Industrial real estate is driving e-commerce and logistics demand throughout Maryland's suburbs. Job growth in suburban employment centers is speeding up, not slowing down. Infrastructure improvements are boosting property values across multiple counties. Commercial and industrial development, like the 726,000 square feet of industrial leasing in suburban Maryland, drives strong housing demand. And despite what I mentioned earlier, we're also seeing new workers, with Maryland having about 2,300 jobs added in early 2025. And all these new jobs generate more residential needs. When you combine these shifts, certain areas are going to see outsized gains while others might lag. Understanding the difference matters when you're trying to time your market entry or exit. Now, let me give you the specific timing strategy that ties all of this together. Here's when and how to make your move based on everything we've covered about rates, inventory, and demand. If you're a seller, the best thing is right now. This is your timing, fall of 2025. You want to list after rates have dropped enough to wake up the buyers, but before you're competing against a ton of other sellers. Right now, you still have the inventory advantage, but that won't last forever. As rate lock sellers start moving out and federal employment effects play out, you'll face more competition. Rates should be dropping and buyer activities will be ramping up, but you won't be fighting the full wave of sellers who are waiting for even lower rates. Now for you buyers, start getting serious too. Don't wait for the absolute bottom rates, because you'll be competing against everyone else who was also waiting. Focus on suburban properties 30 to 45 minutes from either Baltimore or DC. These areas give you the best mix of value, growth potential, and lifestyle benefit. And don't worry about getting the absolute lowest rate. You can refinance. The properties that'll perform best are the established communities with good infrastructure, diverse job markets, and room for development. Look for areas where public money is backing private development, like what we're seeing in Columbia, for instance. And for investors, target areas similar to the suburbs I mentioned earlier: Columbia, Ellicott City, Towson, and others just like that. Why? These markets have proven that they can handle tough times. They have strong demand drivers, and there's room for continued growth. The key is getting in before the full buyer surge happens, but after enough of rate relief makes financing costs work. Also, look for properties in areas with multiple growth drivers: transit access, job growth, infrastructure investment, and demographic trends all working together. Putting all your eggs in only one of those baskets is risky, so look for market conditions that make sense. Look, we're looking at rates coming down, inventory starting to open up, and buyers getting ready to jump back in. This combo hasn't happened in Maryland since the pandemic days, and the people who move first are going to have the biggest advantage. So don't let this market opportunity pass you by. Email me today at hello@waldnerwinnersteam.com, and we'll map out your exact strategy for this shifty market. You can be totally at ease, since my team and I know exactly how to position you for success. Before you leave, let me tell you about Baltimore's impressive future. With over $7 billion pouring into game-changing projects, this city's transformation has already started, and you need to see what's coming next. Click on the video here and check it out. Thanks for watching, guys, and I'll see you on the next one.